Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 277th VideoCast podcast for the week ending February 6th, 2025. Got a lot to get to this week, a lot of exciting stuff, but family first as always. That's me with Annabelle. The girls had something like 8 games between them this weekend for water polo. Pretty exciting. I had the pleasure to speak to an amazing group, about 400 or 500 high school students at La Quinta High School in Westminster, California, home of the Aztecs. Really incredible time. We're going to go into that a little bit here today. Want to thank Cork Snyder, the AP statistics teacher over at La Quinta High School. He has a TikTok channel called Statman for those of you who want amazing tutorials on statistics. Definitely check out Statman on TikTok. Thanks again, Cork, for organizing everything. He's been a long-time listener. Very grateful for that. This was just a picture showing Chinese retaliation against U.S. tariffs. You can see 15% tariff on U.S. LNG and coal imports, 10% on U.S. oil, pickup trucks, farm equipment, and restrict critical mineral exports, and anti-monopoly probe into Google. The consensus on this was that China's response implied they have more to lose than we do. It appears there will not be an escalation beyond this as it relates to China, so that's a constructive outcome, and we're seeing it there. Here were the students as they were finishing up. This is when they were just coming in or just leaving. Anyway, this was packed once we got going, and this shows the trade differential by country. So China's the biggest, Euro's the second biggest, Mexico, Vietnam, and Taiwan. And that's one of the other teachers. And then in one of the games, had one goal just to show one of the kids' goals. I love this one from Mimi. She gets a breakaway. Incredible pass from her teammate. Puts it away. And we're off to it. The other thing, since I had the privilege to talk to these amazing students, Cork students over there at La Quinta, I wanted to just kind of go through some books that I thought were important as a reading list. We get that question quite a bit. So first, Seth Klarman's Margin of Safety, Ben Graham's Intelligent Investor, Ben Graham's Security Analysis, Peter Lynch, One Up on Wall Street, Peter Lynch, Beating the Street, Joel Greenblatt, You Can Be a Stock Market Genius, Thornton Oglove, The Quality of Earnings, Lawrence Cunningham, Essays of Warren Buffett, Robert Hagstrom, The Warren Buffett Way, and Christine Richard, Confidence Game. And then finally a few others here. Inside the Investments of Warren Buffett, 20 Cases from Lou. Margin of Safety with Klarman, we covered that. Measuring the Moat by Malbusin. I think he's over at Morgan Stanley. He writes some really good stuff. Value Investing by Greenwald. Poor Charlie's Almanac, of course. Psychology of Human Misjudgment by Munger. The Outsiders by Thorndike for sure. Quality Investing by Cunningham, and Why Moats Matter by Collins and Brilliant. So those are some things for the students to read if they want to go in this direction for sure. Then I would like to thank Christian Dagger, Preston Mizell, and the great Stuart Varney for having me on Monday when the market was down. I think the Dow was down like 500 points or 600 points in the morning. They texted me, hey, can you do a phoner real quick and tell us what's going on? So I was grateful and happy to do that. We did that, so we're going to listen in here.
On that market, it is a sell-off. We're not coming back much at all. The Dow's off 600, Nasdaq down 470, S&P is down 110. On the phone, joining us now to cover this market, Thomas Hayes. All right, Thomas, this is a big sell-off. Do you see any buying? Are you buying anything? This is a big dip. You buying anything?
I've got my shopping list ready, Stu. I think this is a great opportunity. Look, Goldman Sachs was out this morning saying if this is fully implemented and they don't come to any agreements today, you're looking at EPS dropping 2 to 3% and maximum on the S&P 500 down 5%. So I think the way to look at this is we're looking across our positions in the portfolio. Things that we loved before Friday, we still love. We're going to be slowly adding in over the next couple of days. We're going to be looking for new opportunities. I mean, look, earnings have been phenomenal. We're 77% beat rate, 13.2% earnings growth. We had a positive January. If history is any prologue, that means the S&P is up 89% of the time. So there's a lot to like here. And then we just saw the ISM manufacturing index come in better than expected. We're coming out of a 2-year manufacturing depression in the United States. This is a positive thing.
Okay, give me a name or two. What are you buying?
Well, look, I'll tell you one that I've talked about with your viewers on the show. It's up about 10% since we started talking about it. Is Etsy is the beneficiary of this de minimis exemption that Temu and Shein has been taking advantage of. They're no longer going to get away with shipping junk into this country under $800 with no tariffs. So Etsy, who has the domestic people make the product, is up today on this news. Tremendous company, billion-dollar buyback, recovering internationally, growing the men's business, growing the gifting business. So that's one that we want to add to on this sell-off.
Etsy, I shall remember that. The tchotchke store, as I tend to call it. All right. Thomas Hayes, thanks very much indeed.
And we're back. And then on Wednesday, I had the privilege of doing a normal spot, which was a great segment right here, also with Stuart, thanks to Christian and to Preston. We're going to listen in here.
An investigation into Apple's App Store, and that's taken 2% off Apple stock, down to 227. Thomas Hayes joins us this morning. Apple's down on this possible China probe. The Europeans may retaliate against big tech, American big tech, for tariffs imposed by Trump. Big picture question, is big tech in trouble, Tom?
Well, it's February, Stu. Buckle up, Buttercup, and get your shopping list ready. I think we've been suggesting to trim your Magnificent Seven as a theme for 2025. And part of that is rooted in this trade issue, but part of it is earnings growth has been decelerating, going to decelerate from 33% last year to 21% this year, but the multiples are still elevated. And you're seeing all this CapEx. You saw it with Alphabet last night. They took their CapEx estimates from 60 billion to 75 billion, and they missed on cloud service revenue. So this is a lot of defensive spending. We have yet to see the return on invested capital for all this CapEx. So I think Mag 7 is going to take a little bit of a breather, and you want to play that rotation theme that began in summer of last year.
Let's take these two big stocks in turn. First of all, Apple. Are they now mixed up in Trump's dispute with China? And if so, are they going up or are they going down some more?
Yeah, I think U.S. stock market exceptionalism has been tied to the Mag 7. The concentration is a third. I do think they're going to be target number one, not only for China, but for the EU has put together this anti-coercive instrument they're readying. If Trump levies tariffs, they're going to hit back with that. Apple has a monopoly with the App Store. They get 30% VIG on every single app, so that's going to be an easy target for some of these foreign governments as tariffs are levied, for sure.
Google is way down. They're spending $75 billion in this year, this financial year, on AI. Do they need to spend so much money when China comes along with DeepSeek and does it much cheaper?
It's an existential threat, and this is defensive spending. I think you've got to lower your overweight to Mag 7. I think you want to take advantage of some of the unmagnificent 493 because the bottom line is go where the earnings growth is accelerating. It's accelerating this year in the rest of the market. Last year was the Mag 7 story. Lighten up just a little bit. If you're in indices, you are overweight Mag 7. You want to start to look at some of the cheaper stocks for 2025 for sure.
Got it. Tom Hayes, thanks for joining us this morning. Big day. Thank you, Tom. Now this, demonstrators.
And we're back. And then we're going to go into this presentation to the students at La Quinta. I think it's valuable. Number one, understanding the difference between value and growth investing and the history behind that. And then number two, I got some really great life questions that I think many of you will find useful and valuable in terms of the kind of impromptu responses. So we're going to listen in here.
Columbia 2000. So our principal's from Harvard. So
there you go. They're all right.
And is currently the chairman and managing member, of Great Hill Capital and Hedge dollars in the stock market for accredited investors and qualified institutions. Accredited investors is people that have lots of money. That's how that works. Okay. He regularly appears on television such as networks as Fox, Yahoo Business, Bloomberg, BBC, and others. He is regularly quoted in the Wall Street Journal, Barron's, Financial Times, Reuters, USA Today, and U.S. News and World Report. His podcast, VideoCast, called Hedge Fund Tips with Thomas Hayes, runs weekly, and clips of it often appear in Mr. Snyder's Stat of the Day segments at the beginning of class. He's on X, Instagram, all that kind of stuff. He just moved to Huntington Beach, so we're going to welcome him. He lives in Huntington Beach. That's the bad side of town. Don't go over there. Oh, you were in Fox this morning. I didn't know that. Very good. So this is awesome. He loves to golf. That's the important golf. Love golf. Okay. Sometimes he might miss work because of golf. Okay, let's welcome Mr. Thomas Hayes.
All right, thank you. Wow. Well, that is a very warm welcome. It's wonderful to be here. Wonderful to be in Southern California. We bought a house a couple months ago. My daughters are very competitive water polo players, swimmers. Anyone here swim? No, mostly just statistics in La Quinta. Swimmer over there, what's your stroke? All right, which one? 150? 50 and 100, good for you. Awesome. So I grew up in New Jersey, went to school in New York City. We have houses in Connecticut, and now we're residents of California. So really honored to be here. My wife came up with this crazy idea in September, and I said, well, if we're going to live in Southern California, we got to be able to see the beach from our house, and we got to be able to walk to the beach from our house. And we've been blessed to do that and meet some wonderful people along the way. So I'm going to go through a presentation, and I wish I had seen a presentation like this when I was your age, because it could have probably sped up my career even more so than it has been. I look a lot younger than I am, and I won't correct you. So I go on Neil Cavuto. Are you guys familiar with a TV station called Fox Business? So there's a legendary broadcaster named Neil Cavuto, and I'd go on his show as recent as a couple of months ago before he retired, and he would always say, "This young man is the smartest guy I've ever seen." And I just said, I don't correct Mr. Neil Cavuto. He's an absolute legend, but I'm not much of a young man. So we want to talk about the fundamentals of value investing and some of the edges that I've developed over the years. As Cork was saying, I run my own firm. It's called Great Hill Capital. His AUM numbers, he's projecting into the future. We're not quite that big at this point, but we're going to get there for sure, the way things are going with performance and with everything we've been able to build. Prior to that, are any of you old enough to remember the movie The Big Short? It was with Brad Pitt. It chronicled the housing crisis. So prior to going on my own, I worked for one of the firms featured in that movie called Cornwall Capital. They were one of the few who got the housing crisis correct, made a tremendous amount of money on that trade. And then before that, the first fund I was at was a fund called Bedford Oak Advisors. And the principal of that firm was a man named Harvey Eisen. And he was friends with Warren Buffett for 40 years. So I got to learn and cut my teeth in the value investing philosophy. We would fly out on Mario Gabelli's jet every single year, and that was exciting for me. I was, late 20s, early 30s, going on a private jet to the Berkshire Hathaway annual meeting, as I like to say, off to see the wonderful Wizard of Oz, which was Warren Buffett. And those meetings and those Berkshire annual meetings really, and the mentorship of Harvey, laid the foundation of my investing philosophy, and it completely changed my life. And for a couple of you in this room today, you're going to hear something or see something and you're going to say, that makes perfect sense to me. And then you're going to read a couple of books and you're going to get some experience, and you're going to wind up becoming very, very successful investors. And I will say, it's a lifestyle second to none if you love it and you learn the few principles that will set you apart. So our philosophy in a nutshell is kind of unpopular these days. Right now, everyone wants to chase the shiny objects, which crypto coin, which NVIDIA, which Trump coin, Melania coin. I mean, there's all kinds of crazy things. And that's a sign of froth in a market. And these are the type of areas oftentimes you want to avoid and stick to basic principles. We make our money buying on weakness and selling on strength. What you're seeing in the marketplace right now, due to recency bias, is people are buying those things that are popular in the news today, that are already up a lot, hoping that someone comes in behind them and pays more for the asset, even though the intrinsic value is not there. That will work until it doesn't, and when it ends badly. Our confidence to step in when others are bailing is rooted in deep research and the premise that the more price becomes dislocated, the more risk has been removed. We're going to talk about a company today called VF Corp. And VF Corp owns a few brands you might be familiar with. Anyone wearing Vans today? Anyone? Okay, we've got huge opportunity for turnaround. How many of you were wearing Vans 2-3 years ago? Okay, all right, so the trend hasn't come back to La Quinta High School yet. How about North Face? Okay, pretty much everyone's wearing North Face. How about Timberland? Okay, we have our, okay. How about, do you have a backpack? JanSport, Eastpak? And you carry books around? Okay, so VF Corp owns all of that. And the cool thing about investing is you can learn how to invest in things that you know and make a tremendous amount of money doing it, particularly if you do it for other people as well over time. So a lot of times when most market participants see volatility as increased risk, we view it as increased opportunity. Okay, when a stock is down a lot, what do most people say about that stock? Don't invest in that stock, it's risky, right? Okay. However, if you pick up a few skills that we're going to talk about here, and you actually learn to see under the hood and see what the business is worth, sometimes those dislocations in price are opportunities in a lifetime. And what we try to do is we look for businesses that are marked down sometimes 60%, 70%, 80%, that we can make 2, 3, 4 times our money in a few years of that stock. Would you guys be interested in making 2, 3, 4 times your money from time to time? Would that be valuable? Okay. Okay. So it's interesting. Did the clap light go on or something? Because something, you know, I heard that this is a caffeine-free campus. We might have to change that, ladies and gentlemen. I know you just had lunch. The philosophy of our firm and what I learned from Warren Buffett and from my first mentor is great investment opportunities come around when excellent companies are surrounded by unusual circumstances that cause the stock to be misappraised. I have an apartment in New York City, a place called Bryant Park, 40th Street between 5th and 6th. And I was walking back from the Fox studio after doing a hit, and my doorman said to me, I think Bitcoin had just hit $100,000. And he said, Tom, oh, I saw you on TV, you were great. He goes, should I buy Bitcoin? And I invest in stocks, and I have no view on crypto either way. I said to him, let me ask you a question, Terry. If you put all your money into Bitcoin tonight, and you walk up tomorrow and it was worth 0, would you be surprised? And he looked at me and he goes, if I'm being honest, probably not. I wouldn't be, I'd be disappointed, but I wouldn't be surprised. I said, okay. I said, how about this, Terry? We're here close to Anaheim, California. I said, Disney's stock price is down about 55% from its recent high. 55%. If you put 100% of your money into Disney stock down 55% and you walk up tomorrow and it was zero, would you be surprised? And he said, I would be shocked. And I said, well, that's exactly how we manage risk. So when you get an opportunity to buy a high quality asset like Disney, okay, does everyone love Disney here? Okay, Anaheim, California. How many of you have been to Disney more than once? Raise your hand. Okay, a lot more of you than wear Vans, that's for sure. Twice, 3 times. This is never going to change because the way it works is if you're a parent, and I've got 2 daughters, 10 years old and 12 years old, and you don't take your children to Disney at least once, social services comes to your house and they remove the children from the house and they say that you are not a fit parent. You're abusing your child by not bringing them to Disney. This is the American way. It's always been that way. It's always going to be that way. But Disney has run in cycles for many, many years. In 1984, the stock also fell over 55%. The Bass family, which is a large, wealthy oil family from Texas, bought a controlling stake in Disney, made about 5 times their money over 10 years, made a few $1 billion doing that. And the reason that Disney had fallen so much in the 80s is very similar to the reason it had fallen so much recently, is they had to find a new way to sell their legacy IP library, their content library. And back in 1984, they were transitioning to something called the VHS cassette. No one here is going to know. Does anyone here know what a VHS cassette is? Oh my goodness, okay. Okay, so that's, what do they call that, retro guys? Okay, so they figured out that they were going to take the content library that had proceeded for 20 years and put it on this device called a VHS tape. Stock was down. They're like, that's going to cost too much money. That won't be profitable. Sounds very similar to what? The transition from DVDs to streaming. And for the last few years, Disney lost money streaming. Now they're starting to make money, and the stock is going to double over the next few years. Again, all this is opinion, not advice. Thanks for putting that together, Mr. Snyder. So that's that. Now, how many of you actually are interested in stocks and making money in the stock market? Quite a few of you. Okay. How many of you have tried your hand at day trading? Okay. How many of you prefer investing over day trading? Okay. So I've got the right audience. This is very good. So how does value investing work? I mean, the concept is very simpler, and what's easier said than done is to buy low, sell high, and investing with a margin of safety by purchasing stocks below their intrinsic value. You know, it's interesting, with Disney, for instance, down 55%. Do you think their revenues fell 55%? No. Okay, did their cash flow temporarily impaired because of the investment in streaming? Yes. But on balance, we see these normal cycles that repeat over and over when you buy long-term durable businesses that have lasted decades, and you can buy them during these cyclical troughs and sell them when everyone gets excited. In 2-3 years, you're going to remember this. You'll be in college. Everyone will be like, have you seen Disney stock? It's up like 100% in the last few years. Should I buy Disney stock? My doorman will be coming to me in 3 years and be like, you know, Disney's now $250. Should I buy Disney stock? I'm going to say, no, we had that conversation like 3 years ago. You should have bought it then. Let's talk about something else that's down a lot. So we seek high quality companies that are temporarily out of favor. Some things that are down a lot deserve to be down and may be going out of business. And your job as an investor is going to be to figure out which ones are quality businesses that are temporarily impaired and which ones are actually permanently impaired. Maybe they've been disrupted. Maybe they don't have a competitive moat. Maybe their technology is no longer relevant, which is why we tend to avoid most technology stocks. We learned that from Buffett, because you can get disrupted in a heartbeat because the barrier to entry is very low. And then this strategy, when you're buying stocks with low, and I'm going to emphasize this word, normalized price to earnings ratios, normalized price to book, price to cash flow, Good, I saved that. Don't know where that went. This favors reversion to the mean, okay? And how many of you know what reversion to the mean is? Any statistics agent? Who wants to throw out a broad definition for us? How about you? Yeah. Yeah, that's absolutely right. Yeah. Give him a hand. By the way, the company that owns Vans and Timberland and North Face, how long do you think they've been in business? Any idea? Any guesses? When do you think they started? 1899. Here's a smart guy right in the front row. So they've been around for 120 years, trading in and out of different portfolio brands. That's the type of durable business that over time, if you can buy it, it was down 88% after the last cycle. Why? Because they loaded the channel with Vans. All of you probably have 2-3 pairs of Vans in your closet from 3 years ago. That's all getting worked through. And then the next cycle will come back. And probably your younger brothers and sisters are buying what? The new school Vans, which have the puffy thing on the side, and they'll come back and it'll be another thing. Growth investing varies from value investing in that growth is more chasing the shiny objects, betting on the future, trying to predict the future. I can tell you that I've been around for a while and I've seen a lot of money made and a lot of money lost. There are a lot more people, certainly if you look at the Forbes 400 list, there's only one guy on that list who has made it as a growth investor. But there are probably a couple dozen value investors on the Forbes 400. And for those of you who think Musk is the wealthiest guy in the world, he is, and he's absolutely changed the world. But Buffett, I mean, I know he's only worth 150 billion, but what people forget is he already gave away half of his wealth to charity. So if you add that back, Buffett's done pretty well following a simple strategy, buying things like Coca-Cola Company, buying things like American Express, buying durable businesses that last through cycles. So growth, you're chasing the NVIDIAs of the world. If you remember June 20th, there was a picture of, how are we doing on time, Corey? 45 minutes, okay. So June 20th, there was a picture of Jensen Huang signing for the whole thing, including Q&A. Okay. Signing someone's, I don't know the right way to say it, bikini top, let's just put it that way. Like he was a rock star, like he had that level of fandom and that level of euphoria. And the minute I saw that level of excitement, I put out an article on my website, hedgefundtips.com, which said the next pain trade. Okay, and I didn't get the timing right. It went from 140 to 153. And then I went on Stuart Varney's show on Fox Business and I said, there's a story of Icarus. Icarus flew too close to the sun, and what happened to the wings? The wings started to melt. And I said, the good news is his wings haven't started to melt yet. The bad news is competition is coming. And we're starting to see that. And what happened in the past week with AI? DeepSeek. Competition's coming. They can generate similar type of models, similar type of returns with much more inferior chips, and that's just the beginning, which is going to be good for humanity. It's probably going to be a little bit of a headwind for NVIDIA, and NVIDIA was pricing in great things. NVIDIA will do great things, but price is what you pay, value is what you get. So what we try to do is distinguish facts from reality. So right now everyone thinks if I can just pick the next Tesla, if I can pick the next NVIDIA, if I can pick the next et cetera, I will do better than everyone else. If you go back to 1927, value has outperformed growth, the strategy of buying low and selling high versus buying high and selling higher, by 4.5% per year for over 100 years. Only in the last 10 years has growth outperformed value, and part of that was a function of zero interest rate policy from the Fed, which is no longer going to persist. We're moving to a more normalized rate environment. So unless you believe rates are going back down to zero, you want to look at the long-term data, which favors, and write this down. If you remember nothing from that tall guy who came to your high school class 5 years ago, when you buy high quality assets at good prices, good things tend to happen. If that's all you remember from Tom Hayes for the rest of your life, buy high quality assets at good prices, good things will happen over time. That is the most important message. And this proves it. So let's say you set aside a certain amount of money every single month, like you hear about, to retire, you put it in the S&P 500. All this means the 4.5% a year doesn't sound like much. What it means in real terms is over that time period, your money would have doubled 4 times more if you were invested in value than if you were invested in growth. Okay? So instead of getting to 2, you would have got to 4, to 8, to 16, to 32. You'd probably have 32 million more if you just pick the right strategy over the long term than if you were chasing the shiny objects and getting hit by buses when the fever breaks. When we're buying things down, I'll cover a couple of things here. We tried to do solvency risk analysis. So key thing is, we did a simple example about Disney and VF Corp. Are they going out of business? Because if a stock's down 80%, there are people in the market that think that company is going out of business. So you have to look at the balance sheet. You have to look at their cash flows. You have to look at their revenues. And once you can get confidence they're not going out of business and they have runway, then you start to look, does the business have a moat? Does it have a competitive advantage? How's management? In the case of VF Corp, they got a new manager named Daryl Bracken. Okay? Daryl previously ran a company called Logitech. Are you guys familiar with, or Logitech? Do you guys, any gamers in the room? Okay. Logitech makes this little simple thing called a mouse, and they make this other thing called a camera. Are there any other companies besides Logitech that you can buy a mouse or a camera from? It's like unlimited, right? It's a commodity product, but Bracken is a special manager. Bracken came in as the manager of Logitech, the CEO, when the stock was down 82% in 2013. Over the next 7 years, he turned the company around. The stock went up 26 times. Now, Logitech was not curing cancer, okay? What they were doing was selling little plastic mouses that anyone could manufacture in China. They had these little cameras, but due to his management, his positioning, etc., if you had invested $100,000, that would have turned into $2.6 million in about 7 years. Is that pretty impressive? So when he came into VF Corp and the stock was down 88%, down from some $90 down to $13, $12, $11, we got extremely interested in VF Corp because number one, we had done the solvency analysis, we had done the moat analysis, we had the management catalyst, and then near-term catalyst was Bracken Daryl taking over. Our basis was $15 and change. It got up to $27 recently, and it's just getting started. So we'll probably make 3 or 4 bags on that 3 or 4 times over time, and that's all we do, rinse and repeat. 2 things that give us an advantage over our competitors. Number one, time horizon. We take a long-term view. Our average holding period is 1 to 5 years. I know that's not fancy nowadays. It's 1 to 5 minutes if you follow TikTok. They want you in the afternoon with 0-day options and out by 4 p.m. That gambling, sooner or later, always catches up. There will be one out of a few million that makes some money, but they always give it back to the casino. So just have patience. You'll see how that works. And then the temperament is the ability to drown out noise. A gentleman asked me earlier today, don't you watch your portfolio? You've got tariffs today and all that stuff. And the answer is, I know the price that we're getting out of a company before we even get into a company because I've looked under the hood and done the fundamental analysis. And we're going to talk about some things to take advantage of that. We started to cover VF Corp. I wanted to cover a few names with you here. That's Bracken Darrell, by the way, and he did a couple of things straight out of the gate. Number one is he took bankruptcy risk or solvency risk off the table the minute he came in, and he sold off the Supreme brand, okay? Is the Supreme brand going up or going down? Down, okay? So he sold it for $1.5 billion. He sold it to pay off debt, and now their solvency risk is no longer off the table. He can focus on turning around Vans, which is improving sequentially. The improvement starts in Europe, it starts in Asia, and then eventually it'll get to the US. Watch, within 1 to 1.5 years, I'll bet when I ask who's wearing Vans, probably a third of this room is going to raise their hands again. It's going to be like 2000. When did you all own Vans? 2021, 2020? Is that basically when they were hot? Yeah. 1982? That's a durable brand? Yeah. Yeah, and they've still got the building there on the highway I see when I drive the girls to Irvine to swim. So that's a big thing. North Face is a no-brainer. Everyone wears North Face. It's huge in Asia. And by the way, they're going to benefit immensely from the turnaround in Asia, okay, as China comes back, which is starting to a lot of stimulus over the past 2 years in fits and starts, and now it's all starting to come together. So we think this can, short-term conservatively probably move up from, it's moved up from 15 or 13 to 27. We think it goes to 40. And then from there, we'll look and see how the execution is, what the fundamentals look like. But I was listening to Bracken after last week's earnings, and I think he's going to run this thing back up to new highs, and it's going to take a few years, and he's going to build an incredible franchise, and he's an incredible leader. Second one, Alibaba. Has anyone ever heard of this company? Oh, a lot of you. Okay, good. So Alibaba is basically the Amazon of China. And the most important thing you need to know about this, because we're going to want to open for what, about 30 minutes for questions? Is that?
Yeah. Maybe go for 10 more minutes and we have like 15 minutes of questions.
Yeah, okay, great.
I'll let you know.
What do you guys like, lectures or questions? Questions? Okay, good. So lecture? Questions? All right, hands up if you like questions. Hands up if you like lectures. And the rest of you are probably in the lecture camp because you're sleeping. No, I'm kidding. All right. So this is a perfect example of price is what you pay, value is what you get. So during the COVID surge, the stock hit just over $320 per share. And post-COVID, it dropped down to about $58 a share. Okay, so more than, how much of a drop is that? All the math whizzes in here. 320 down to 58. You can ballpark it if you want. All right. All right, let's call it over 80%. We love the 80 round number. So it's like, why would the price drop 80%? I mean, if you saw this stock chart and someone said, I got a great stock for you, and you looked at the chart, what would you say to them? I mean, the thing has fallen. It looks like it's gone out of business. Is that correct? Okay. Do you think most people, if you walk down the street and show them this chart, would say, yeah, that's a stock I want to buy? No. Okay. So let's talk about what's happened in terms of financials over that time period. If you look back, the company IPO'd in 2014. Back at around these prices, it was around $88. So that's all the way on the left side of the chart as you guys are looking at it. Since then, price is basically around the same. It started to rebound off the bottom. It's around $100 now, but it's basically trading for the same price as it did 10 years ago. The difference is revenues are up close to now 10x or 1,000%. Earnings and cash flow are up about 6x or 600%. So you're getting 600% more free cash flow, and all that really means is money left to you as the owner of the business, because if you own one share of a company, you are an owner of the business. for the same price. And these type of divergences between intrinsic value and price are where fortunes are made. There's no other surer way, in my view, candidly, to make insane amounts of money than buying high quality assets when they're temporarily out of favor. There's nothing like it. Like if you were to walk into the board of this company and say, I will buy the entire company at the price that it is quoted in the public markets today. I'm financed by JP Morgan and I'll put up some equity on my own. Will you sell me the company? They would call security and have you removed from the building because they would think you were absolutely lost your mind. They would think you're crazy. And yet, every single day in the public markets, prices react so extreme to the short-term headlines, to the short-term noise, to the short-term fashion show, okay? Like certain clothes go in favor, out of favor. Certain stocks go in favor and out of favor, unrelated to the underlying fundamentals. So if you don't wear Vans today, forget about the fashion because no influencers are ramped up yet. We'll get the influencers going. It's going to happen in about 12 months. Do you think the quality of the Vans product is good? Like when you wear it, is it durable? Or is it garbage and it falls apart? It's durable, right? It's a good quality thing. It's a reasonable price. It's just temporarily out of favor. That's what the sneaker is. It's the same thing that's happening with the stock. And then all of a sudden, you're going to see in 9 months, 12 months, my girls are 10 and 12, let's see. Sabrina Carpenter is going to put on a pair of Vans, and half of this room is going to buy a pair of Vans. She won a Grammy last night, right? You guys you guys only do statistics up here? All right, good stuff. All right, so Alibaba is basically the Amazon of China, and it's effectively an AI ETF in China. So if you want to own a piece of every single AI startup in China, you want to own Alibaba. Why? Because they give startups compute power. They give them cloud services for free, tokens in exchange for equity in their company. And most people aren't aware of this, so it's not priced yet into the stock. But when you see things like Qwen 2.5, their model actually beat DeepSeek. They put out the data last week. That's why the stock is up. That's why it's just getting started. So any of you play poker? Yeah, so a lot of you, good. So in poker, there's something known as outs, okay? And in Alibaba, we have a lot of outs. Number one, it's the number one cloud provider in China. Number two, it's the number one retailer to the middle class. So in the last 2 years when the economy was down, who did well? The companies like Temu selling the cheap junk that no one really cares. You buy it all and then you never use it and you put it under your bed. Alibaba caters to the middle class and the upper class. The higher end luxury brands are all on Alibaba's platforms. You have Taobao, you have Tmall. International business is growing 30, 40% like a weed. And their AI model is faster than OpenAI. It's faster than DeepSeek, and it's just beginning. And you can buy it at 5, 6, 7 times earnings, which its historic normalized multiple is like 25 to 30 times when it gets back into the fashion show and people get excited and Sabrina Carpenter starts wearing Vans and all that stuff. So these are the type of things. So this one, it's trading at about $220 billion market cap. It's got $70, $80 billion of cash and 5, 6, 7 times earnings. That doesn't exist. You compare that to something like NVIDIA is trading at 50 times earnings. So price is what you pay, value is what you get. You can pay a lower multiple for more earnings with something like Alibaba, or you can chase the shiny object and get your face ripped out like NVIDIA's down 24% in the last few weeks since DeepSeek. Couple tips, anyone looking to get into the investment business, hedge fund world? Okay, about 10, 20 of you. Okay, so I would say a couple of things. MBA can help. I think CFA is more important if that's the route you want to go. I think certainly a statistics background is useful. You got to have math. You got to have accounting, finance, economics. We've got basically all those teachers in here. And for me, I would say part of the reason that I'm here doing this speech is because a guy named Warren Buffett was generous enough to share his ideas. If he wasn't so generous with the population and sharing his ideas, I wouldn't have a career. And I've been able to build an amazing life for my family, for myself, for my clients, as a result of the principles that he taught and the principles that he learned from a gentleman named Ben Graham, who wrote the book, The Intelligent Investor. And my best suggestion to everyone in this room is read the book, The Intelligent Investor by Benjamin Graham. And one of two things is going to happen. Either one, a light bulb is going to go off and it's going to change your life and you're going to go on to become an incredible investor over time, make all your dreams come true. Or number two, you're going to say, I didn't really understand what that Ben Graham was talking about in 1923 or whenever he wrote the book. I'm not interested. And then you're going to go off and become an entrepreneur and create things that are going to change the world. Either way is a great path. I'm very grateful for the path that I got into, partially by accident, and I hope that makes a difference. But I think that's one way to kind of get some education. If what you read in that book sets a light off, I would suggest you read every single annual letter Warren Buffett has written since he started managing money in the 50s. And those lessons, and I've done that, will absolutely almost guarantee that you will be a successful investor over time, because no one does it. You'd be amazed the amount of money that's managed by people that don't know basic fundamentals and basic principles that Ben Graham started, Warren Buffett implemented, and there's probably a couple hundred people around the world that implement those principles well, and you know who they are by their results. So with that said, let's open it up for some Q&A.
Okay. So, if you have a question, come on down here on the line, okay? Come on over here. Okay. Okay, here we go. This will be good. I'm a little nervous. Go ahead.
What investors should you make? What's your story?
Yeah.
This is your emotion.
Yeah.
What stocks would you recommend?
Yeah, I think that's a great question, by the way. Give her a hand. I think the number one thing you can do at any age, if you're just getting started investing, is decide every single month that you're going to pay yourself first. And you're going to set aside, whatever it is, $200, $400, $500 a month, and buy the S&P index fund or the VTI Vanguard All Market ETF. Low cost, it'll give you exposure to the top 500 stocks, and just do it every month, because when the market's high, you will buy less shares automatically. When the market's low, you will buy more shares because it's the same amount of money, and that will compound over time. And then that gives you the runway and the security of savings where you can start to learn about individual stocks and maybe start to outperform over time as you enjoy that. But that's probably the best advice I would give. Although it's all opinion, not advice.
How much money do you make?
I will say, I will say, first off, it's a reasonable question. It's the wrong question. No. So the right question is, how much are you worth? Okay? So how many of you have read the book Rich Dad, Poor Dad by Robert Kiyosaki? Okay, that's a life-changing book. That's a book that you all need to read, because I grew up poor, like lower middle class. So when I was 10 years old, I had a paper route. You don't even know what that means, but you delivered these physical things called newspapers to people's doors and asked them for money. I was a dishwasher from 11 to 12. I was a golf caddy from 12 to 17. And when you grow up poor, the only thing you think about is, how much money can I make so I can buy some piece of bling or this or that? Once you get rich and you have done that, then all you think about is, what assets can I buy that generate more cash, that continue to build more wealth, et cetera, et cetera, et cetera. So you're thinking less about ordinary income and you're thinking more about investments that generate cash that can pay for everything that you want over time. So I'll leave it at this. It's beyond anything I could have possibly ever imagined. I didn't plan it. I was always ambitious. I was always willing to do the work. But I think the best answer is I make 75% less than my clients make. Because in order for me to get paid, they've got to make money. And the way my business is set up is if they don't make money in a given year, how much do you think I make? 0. We have no management fee. 0. Only performance fee. And we set it up that way because we simply copied what Warren Buffett did when he was managing outside money. We don't believe we should get paid for watching people's money. We believe we should get paid for results. And once you think about how much value can I deliver to other people, you will get more money than you could ever possibly imagine. So whoever asked that question, and it's a good question. And the other thing is you'll get to a point when you don't have to work anymore. Then it's about freedom. 2, it's about making a contribution. And 3, if you're an athlete, it's honestly about competing and winning. Like there's a real joy in doing the best work you are humanly capable of. And I hope you maybe have that a little bit in your school studies right now. It's not just like, oh, I got to get good grades to get a good job to make my parents happy. It's like, no, let me see what is the best I can possibly do given the genetic lottery that you won to be here in beautiful Southern California. I mean, you could have been born in Bangladesh with no food and no water, right? Instead, you got born, somehow you were born in sunny, beautiful California in America with a beautiful school, with teachers that care about you enough to call this guy for 3 months to say, come speak to my students. We don't realize how lucky we have it to be born where we are and have the opportunity. So, a lot. All right, good.
Do you follow Statman on TikTok? And what do you think about TikTok?
First thing is Statman. Of course I follow Statman. Who doesn't follow Statman? Everyone follows Statman. What was the second question?
What was the other one? And what do you think about his TikTok?
I'm still trying to understand the lessons. One of these days I'm going to understand statistics so well I can really make some money. But for now, I'm learning every single week I listen to his lessons. So next question.
How big is your house?
Which one?
You said you didn't come from a lot of money. What's going to be some advice you give to our generation?
What you lack in capital, you can make up in labor. So what I decided at 10 years old, I was just going to outwork everyone around me. I mean, the one thing that my parents did right, and they did many things right, was they believed in education. And they pushed me to go to school even though I didn't want to, but everything that I wanted to do for myself, I had to earn. And I would just embrace work. I think being a golf caddy was the best thing that ever happened to me because I realized at a very young age I never, ever want to have to do manual labor. I want to get paid for my mind. And I learned that at a very young age. And a lot of people coast through the cool kids in school and all that stuff. And you'll be shocked. All the people that you think are going to be the stars of real life, that are the stars right now, are going to be working for you. So when people are tough on you and et cetera, just use it as motivation to work harder, become better, pursue your dreams, and no matter how many times you get kicked in the face and you fall down, get back up one more time. Good question.
Can you study the difference between momentum investing and turnaround investing?
What's the second one?
around investing?
Yeah, that's a great question. We tried to cover it a little bit. So momentum is kind of chasing things where the price has gone up a lot, not necessarily grounded in fundamentals. Oftentimes, high price to sales multiple, earning little to no money, but everyone thinks it's going to be the next big thing. By the way, Amazon.com in 2000 was trading similar to like how an NVIDIA was today. Everything that people thought Amazon was going to do, it actually did. The problem was in 2000, you were already paying the price for what would happen eventually 15 years later. On an app, stuff comes to your house the next day, or if you're downtown Huntington Beach, it comes to you that day, or in like an hour. It's crazy. The cloud computing, all those things. So what happened? The stock ran up because all these great things were going to be happening. Everyone was right. All the great things happened from Amazon. Everything we thought they could do, they did and more. The difference was they got too excited too early. The stock fell 92% from 2000 to 2003, even though the fundamentals of the business were improving, very similar to what's happening with Alibaba now, before they recovered and went on to do great things. So you can be right about the narrative, but if you pay too much for an asset, you're going to get hurt. And so what we try to do is take the opposite side, invert like Charlie Munger says, and say, well, if that's what's going to hurt you the most in business, what's going to help you the most is buying a great quality asset when no one wants it and then riding it back up. And that's what we try to do and play the mean reversion over time. Great question.
What was the biggest break in your career when you were younger?
Biggest what?
Biggest break in your career?
Oh, biggest break. Probably I think the biggest break in my life was probably marrying the right woman. Yeah. Yeah. Because that's probably the most important decision you'll make in your life, by the way. Because I was willing to take risks, and she was never like, oh, if we do that, what if we lose this? What if we lose that? She was always like, try it, we'll figure it out. Try it, we'll figure it out. So I never had that like nagging, like, what if this, what if that? She was always just willing to be like, let's go for it. And I think that's number one, pick the right partner. I would say my first hedge fund boss was, taking me into that value mafia world, bringing me around to the meetings, the hedge fund lunches with Lee Cooperman and Mario Gabelli and the annual meetings with Warren Buffett. That was life-changing and kind of just learning by immersion. He never really sat me down and said, learn this, learn. I learned by immersion, and I had to self-generate the motivation because he was already very wealthy. He didn't have the motivation to train an analyst and everything else. So I think that was a break. I would say the other advice I would give that took me longer to learn was, hard work and effort and persistence. And smarts. That's kind of table stakes if you want to perform at the highest levels. The quantum leaps, if I have to look back, happen in the social circle. And that's hard to understand. So 2 things I would say about the social circle. Number one is hang around with people who are better than you. If you want to be a better golfer, play with better golfers. If you want to be smarter, hang around with the smartest kids. If you want to be faster, swim with the fast. I'm in here in California because this is the best water polo in the world, and my girls are serious about water polo and swimming. So this is where they need to be. They got to be around the fastest people because being number one in, wherever, that doesn't matter, is not going to help them. So I think you have to, I'm not social by nature. Once I realized that all the quantum leaps in my life came as a function of the social circle, I forced myself to be in situations around people who are smarter than I am, better golfers than I am, wealthier than I am. Not to climb, it's just to become the best you can possibly be in whatever you're up to. If you want to become a fashion designer, don't hang around with people that have no fashion sense. That's really what it comes down to. If you want to be a fast track star, run with the fastest kids so you feel like you're slow. Don't run with the slowest kids so you feel like you're a champion, because you'll never get better that way. Yeah. That's hard. I would say, econ is a good major. Business undergraduate is a good major. If you're going to go to business school, I would go to, if you want to get into this, I'd either go to, if you can get into Columbia or if you can get into Wharton for business school, if you want to be an investor, those are probably good places. But honestly, the CFA designation, you can study on your own. You probably have the books in your library, and if you don't, you can get them at the public library. Start to study for the CFA and educate yourself. Formal education will make you a living. Self-education will make you a fortune. Anyone who's achieved things that you think you want in life, they're exceptional. Yes, they know the basics that you all learned in college, but they developed an edge or a method or a way of doing things from experience and from self-study, from self-learning on top of the basic learning that really pushed them ahead. So yeah, I've seen it. I've seen everything. It could be English, it could be history. You learn how to write and communicate, and then you take the CFA on the side and you develop skills and that type of thing. But I would say accounting is the language of numbers. Very important. I know there's an accounting teacher in the back. Econ, business, all fine. Have some statistics courses and that type of thing. Yeah, thank you.
We got probably time for about one or two more, okay?
How do you use AI in your job?
Good question. It's currently not at the level I want it when I ask it the questions I want it to answer, but it will be, and I'll use it more and more. I mean, for me, the number one thing is I'm not interested in second-hand interpretations of analysis on the assets I'm looking at. I want source materials. I want public company materials, and I draw my own conclusions. And some of that comes from experience. Simple answer, I need to get better. Second simple answer is so does the technology. But yeah, I'm going to explore that with you. I mean, right there it tells you why the playing field is leveling. And if you can master some of these things, you can disrupt things that have been in place for many, many years. So get after it. You'll do great.
Okay, last question.
What role have relationships and connections played in your life?
Yeah, this I learned later in life. I think it's probably the most important thing you can do other than table stakes. Learn the skills and invest. So I would spend a lot of time doing that and do it with people who make you grow and people who want to see you succeed and people who push you to be better. And if you're focused on that, I think the sky's the limit. So yeah, great question.
Okay, I want to thank a couple people, Mr. Goals, Jennifer back there, and company back there. Thank you very much, Mr. Goals, and of course, Mr. Thomas.
Thank you. And we're back onto the data. We've got a lot to cover this week. First and foremost, let's kick it off with this chart. This is not really what you see at market tops, even though we are in February, and February is the second weakest month of the year. So just keep an eye on that. The global policy rate cuts easing cycle has peaked at 62 cuts last year. That is now going down, but that doesn't mean that bad things happen in the market. If anything, that means that good things start to happen. Few times it peaked, April 2009, May of 2000. Those were really generational buys. Automotive sales volume, again, beat the last 2 years in January, down from December. That happens every single year, so that was good to see. European stocks still trade at a much lower earnings multiple than their U.S. peers. People looking at this chart would say, well, that's the way it's always been. But if you go back 30 years, you will see that international and U.S. exceptionalism runs in normal cyclical peaks and troughs, just like value and growth. And this time will be no different. Trump's tariff plans would bring rates to highest in decades. So if all of the U.S., Mexico, and Canada kick in, it would take us back to not holy smoot levels, but those levels in early 2020, those levels in early like 1920, and then you had another 8 years of robust economic growth until holy smoot at the end of the 20s, early 30s, which most people attribute to the Great Depression. But we were raising tariffs for 12 years beforehand and had a period of excess prosperity. So I don't think all of these will hold. So therefore, I don't even think we're going up to the levels that preceded a decade of prosperity. But we know which direction we are going is up off of historically many century low levels. European banks and secular bull. This is interesting. That shows some of the value trade in Europe starting to take off. European value stocks outperforming growth stocks. Europe growth versus value rolling over. This tends to, that's interesting because they rolled over in the same way in 2000, 2001 ahead of U.S. growth rolling over value. We've been talking about this for a long time. It's now starting to move toward a consensus point of view. We and the listeners here were ahead of the curve on that. New orders inventories pointing to upside in global PMIs, manufacturing recovery we talked about with Stu. Exceptional U.S. growth driven by exceptional government spending. That is going down, ladies and gentlemen. If you haven't been paying attention to Doge, follow Elon Musk on X, and you can see example after example of egregious waste of taxpayers' dollars. It's really disgusting what had been going on, and it's good that it's getting cleaned up. It's going to be good for bond yields. It's going to be good for the country. It's going to be good all around. Meanwhile, intelligent investor bull bear ratio remained relatively low. Bullish for stocks. That's from Yardeni. Your investment. This is funny. This is in a meeting between Jeff Bezos and Warren Buffett. Jeff Bezos asked Warren Buffett, your investment thesis is so simple. You're one of the richest guys in the world, and it's so simple. Why doesn't everyone just copy you? And Warren Buffett responds, quote, because no one wants to get rich slowly. And so there you go. And there are a few of us that have copied and added our own twist and everything else. And as you can tell, it works quite well. A positive January is a good thing for 2024. This is from Dietrich over at Carson. Negative Januaries tend to end up negative for the year with a negative 1.8. Positive Januaries, the average tends to be 16.8%, going all the way back to 1950. We're not that optimistic. We think 8 to 12 this year, but we'll take it if it comes. I think flows here, this is showing flow of funds that tends to peak out mid-February. The last 2 weeks of February tends to be bumpy, so buckle up, Buttercup. Moving on, economic policy uncertainty has soared, so that's what you see when in 2001, which we continue to reference as a great analog for a lot of the things that we're doing. And then in May 2020, which was just an unbelievable year for us. So we love conditions like this. This is makes us smile so wide we could eat a banana sideways. Earnings growth as a friendly public service announcement, ladies and gentlemen. Go where the earnings growth is and accelerating. And that is where small cap dramatically more, that followed by mid cap, followed by large cap. The exact opposite of what's happened last year when Mag 7 outperformed. Now value small cap, mid cap, international is already and will continue to outperform. Industrials even better when PMI is less than 50 and rising. This is from Fundstrat, and this is the condition that we're in right now and shows how industrials outperform. These are the monthly return stats. As you can see, February is the second worst month of the year behind September and tends to be excessively weak. Early February, like this week, and then end of the month also. Here is TLT Treasury bonds. We've been saying bonds will get bid in 2025. That's already started to happen. And you can see all the dumb money piled into short interest, which is what they do at every single bottom right before big bond rallies. Crowded trades, a theme of what we like to cover. This is the Goldman Sachs Manufacturing Survey Tracker, precedes Manufacturing ISM, coming out of a 2 year depression in manufacturing. This is going to be a critical theme. Median 2-week S&P 500 since 1950. As you can see here, the second half of February, second half of June, second half of September tends to be terrible, and the first half tends to be okay in February. So that is what it is. Don't be surprised if indices are bad and many stocks we own are good. I know that continues to be a contradiction, but it continues to happen in real time. January was phenomenal, and I think we're going to see more of the same throughout the year. People in passive, overweight Mag 7 without knowing it by owning the indices are going to be unhappy, and people who have done work and bought great businesses that were marked down are going to be generationally happy. And that's exciting. So U.S. share of global indices has risen recently, but the earnings has not risen commensurate to that. And what happens, like you saw in 2000, when it gets too far ahead and the earnings growth lags, it catches up, and that's going to be all the Mag 7 coming back down to reality when everyone realizes the emperor has no clothes, and all the CapEx has led to negative return on invested capital and decelerated earnings growth. That's the bad news. The good news is all the miracles that we expect AI is going to do are going to happen. They're going to, one, take a little longer than everyone expects, and number two, you're already paying for all those miracles that you expect. So price is what you pay, value what you get. The good news is it's got to happen. The bad news is you already paid for it, and that's why they're coming in, and people are surprised until they're not. Corporate sentiment hits record highs. Dow Jones 10-year cycle, as you could see on average, years that end in 5 tend to be one of the best years of the decade. We'll see if that holds true this time as well. This is interesting about the prices of goods. The tariff premium, U.S. states imposed tariffs on washing machines from February 2018 to 23. Here's how it affected prices compared with overall inflation and appliances as a whole. So they did initially, they went up, then they went down, and on balance, they have underperformed overall inflation and in line with overall appliances. What they're saying is in the short term, it's inflationary. In the intermediate to long term, it actually has no difference. Strong buybacks despite elevated rates and valuations. Growth is lagging value by 3 percentage points year to date. That's good. That's normal. This is abnormal. 2015 to 2023 is abnormal. If you look back through the rest of history and then go all the way back to 1927, value outperforms growth by 4.4% per year. We are moving back into that regime. Number of companies expressed optimism. And this is the reason for the broadening. I continue to remind you and to enlighten new viewers. The reason is Magnificent 7 earnings growth is decelerating, dark blue. Unmagnificent 493 components of the S&P 500 earnings growth accelerating, and you're paying half the multiple. So price is what you pay, value is what you get. Faster earnings growth for half the price. That's where I want to be. Covered this. This is interesting. The dollar index is back to levels that killed tech stocks in 2000. I don't think this is a great chart, but I do think it's worth noting. And I'm not calling for this type of tech wreck that we saw in 2000. I am calling for an underperformance, and we're already seeing it effectively since last July, but certainly more pronounced in 2025. And I think this dollar is rolling over, just like you saw in 2001. It will persist weak, which is going to help the small caps, going to help the international, going to help the value over growth as this dollar weakens, and probably continue to create an environment where Mag 7 will underperform. February isn't a fan of post-election years, negative 1.3% on average, probably skewed towards the second half of the year. Here's from Seth Golden. The key to 2025 in one all too relevant chart, equal weighted S&P 500 versus cap weighted tech, triple bottom. He's showing here in this box. Speaks to broadening rally, projects Magnificent 7 dominance fading, suggests small, mid, unprofitable tech rising, equal weight and down cap tier outperformance, i.e. small cap, mid cap. And what he's leaving out there because it's not reflected in the chart is international outperformance, and we continue to be in that camp. Jobless claims ticking up. This, we'll see what happens tomorrow, but signs are pointing towards a weaker jobs report tomorrow, in which case we would see a continued bid in 10-year bonds, i.e. yields compress. Trump and Bessent said as much. They're not really going to be on top of the Fed to cut because he's out next year anyway. They're going to focus on bringing down the 10-year yield. And they're going to do so, obviously, by cutting expenses with Doge, giving the market confidence that spending is under control. Maybe being in the market buying. I don't think so. But because that is the rate that controls mortgage rates, and which controls the housing market, which is why they want to focus on that, and obviously refinancing the government debt, and that's a critical factor. Revision suggests more moderate U.S. payrolls growth, so that we haven't seen a revision this large since Obama in 2009. Volatility is the toll we pay to invest. This is a very important chart from Ryan Dietrich over at Carson. Since 1928, various declines per year. On average, you are going to get 7.23% dips every single year in the indices. You are going to get 3.45% corrections every single year. Every 1.1 years, you are going to get a 10% correction intra-year. These are normal. This is the toll we pay to invest and get outsized returns above inflation over time. 15% severe correction, half of one every single year. So every 2 years, you're going to get a 15% correction on average. And every 3.5 years, you are going to get a 20% bear market. The good news is, I think we pulled forward 2 of them, since we had one in 2020 and we had a second one after the technical recession in 2022. We had a 25% drawdown, so we had 2 of those in a period of 3 years. Basically 2 years, and you should get 2 of those every 7 years. So we pulled forward 5 years of 20% corrections. So, something to keep in mind if you get too bearish on any given day. Here is Ryan Dietrich. Very strong January for stocks, but be aware the first quarter of a post-election year usually isn't all that strong. Barely positive. That's going back to 1950. So expect that volatility. You could see a lot of those losses and volatility in the top 7 stocks. And even though the indices are down or flat, seeing enormous great things happening with the Unmagnificent 493 and other groups we've been talking about and telling you to get positioned for. Or even better, if you're a client, positioning you for. So a good start for 2025 could mean the bull continues. Average gain, when you get a greater than 2% year-to-date return in January, the final 11 months of the year on average tend to be up 12.3% as opposed to the normal year of 8.1%. And for the calendar year tends to be up 18.4%. So we shall see. Extreme stress for the auto supply chain if tariffs last. John Murphy estimates that auto prices would have to increase $3,300 on average to offset the proposed 25% tariffs. Imported from Canada would be more. Such prices would exacerbate the affordability challenges for the auto consumer. U.S. typically imports 7 to 8 light vehicles per year. 4 million come from Canada and Mexico, etc. So a lot of people have asked, is Cooper Standard going to be hurt by this? Is Stanley Black & Decker going to be hurt by this? Is Whirlpool going to be hurt by this? Yes, yes, and yes. And yes, it's probably mostly priced in at this point. And the reason is people still need cars and washing machines and all this stuff. All this is a tax on the poor. That's all inflation and price increases ever are. So, it's like, okay, we're going to create an external revenue service and we're going to collect more money from tariffs so we can lower taxes. Okay, great. Money's fungible. So now what happens is the tariffs increase the cost of goods in the short term, which is a tax on the poor, and then you lower their taxes to offset it and make them think that they have lower taxes, but in effect they have lower purchasing power, which effectively is a wash. So at the end of the day, there aren't many people signing up to manufacture hammers and DeWalt chainsaws and sealing systems around the doors and the windows at $5 an hour in Detroit, Michigan, or Mississippi, or any of those places. So what's basically going to happen is it's going to be passed through to the customer and at a higher price, because no one's going to set up shop and say, oh, Stanley's in trouble, I'll just manufacture in the US and undercut them on price. It's simply not going to happen. Even after the tariffs, Stanley's still going to have a competitive advantage and the moat. So all of this stuff is just noise to take you out of great companies that you own, and many of you have fallen for it, and I'm very sorry for you, but we have used the opportunity to pick up some of those shares, and we will continue to do so. Thank you very much. This shows the U.S. import many key goods from tariff-hit nations: beer, fruit, vegetables, distilled spirits, poultry. I mean, do you think people are going to not eat fruits and avocados and beer and vegetables because it's up an extra 25 cents? At the end of the day, they're going to eat what they're going to eat. They can't get it anywhere else. They're not going to get it cheaper. No one's going to just stand up a plant in 5 minutes and say it's cheaper, no tariff avocados. It's just, that's not the way it works. Top 5 imports by value from Mexico. Vehicle parts, that's just going to be across the board. I think that's will be partially offset if the tariffs stay. I mean, at the end of the day, Kevin Hassett, who's a member of I think he's heading the National Economic Council under Trump, came on and said, this is different. This is not a tariff war. This is a drug war. So as soon as the president of Mexico and Canada, Prime Minister of Canada, said we're going to send 10,000 troops to the border and stop fentanyl from coming in, Trump backed off. So I guess if they keep those troops there, there's a decent chance that the tariffs will be delayed for Canada and Mexico, and the Chinese ones, the market took it like a champ, and that's that. I mean, that's really what it comes down to. So select recent notes addressing tariffs on China, Mexico, and Canada. More noise there. This is interesting. The AAII sentiment survey. This turned somewhat bullish in my view because the retail investor got very bearish this week. Maybe that comes down a little bit further, but again, this is not things you see really at tops. You see it closer to bottoms. ISM services was a little weaker than expected. So services coming down, goods coming back. That's good for a lot of our positions. 10-year government bond yield. Everyone said it was going to 5. We said, nope, not going to happen again, just like we said back here. And we're down to 442, headed much lower. Japanese yen starting to strengthen. These are the things that we said to keep an eye on as the carry trade unwinds, which means billions upon billions of free yen that has been parked in Mag 7 is coming out. This is the story, not DeepSeek. It's the carry trade unwind, and no one's paying attention to it. And when you try to talk about it, no one wants to hear about it. So I don't talk about it, but I just benefit from it. Argentina vehicle sales year on year. This is what happens when you get good government policy in place. It turns around the country, and that's a positive thing for Latin American auto sales. China's crude imports from the U.S. elevated here, so they basically put a tariff on themselves because they don't have any real natural resources of size to sustain their population. Question is, how much are they going to get from Russia? And we'll see. China's crude imports from Canada and Mexico. So Canada has been the big beneficiary from this trade war as far as what looks like a continued trend. Canada will send China more money. Their costs are a little bit higher because they have whatever it's called, the dirtier harder to refine type stuff. But anyway, the point is, and Mexico will be a small beneficiary of that as well. International markets still trading at a discount to the U.S., cheapest being emerging markets in China. We're going to continue to take advantage of that. Here shows the data centers around the world, 11,800. U.S. has 5,400 of them. China only has 449, so we've got a big lead there. Job openings coming down, declined sharply in December to 7.6 million. It's probably in line with an expectation of a weaker jobs report tomorrow. Japan wages grow by the most since 1997, helping BOJ rate path and yen. So yen is getting stronger. Rates are going up in Japan, i.e. carry trade is unwinding. Mag 7 will continue to be under pressure so long as that trend continues. This time is different. The Trump trade war in 2018, U.S. represented 19% of China's total exports. Now it's down to 15%. So it doesn't hurt them as much. They have less incentive to negotiate, and they haven't. They could basically destroy Apple in one fell swoop, and it's already happening on its own. Their sales were down 11%. They blamed it on not having AI, which their AI product is crap right now. It will get better, but preview of coming attractions. And then they went after Google, which has for an antitrust thing. So they will take down, and Europe will take down, and all these guys will take down to the extent that Trump wants to do tariffs. These bureaucratic bodies will just start to shake down the Mag 7 for antitrust, anti-monopoly, and fines. So that's how they will hit back. We estimate that a 10 percentage point increase in U.S. tariffs on Chinese goods would weigh on China's real GDP by 50 basis points. So last year they did 5.4% GDP growth. We did 2.5. According to this, if these tariffs sustain, they'll be down to 50 basis points less than estimates. Let's call it around 5%. Double our growth. China's LNG imports from the U.S. has accelerated and continues to accelerate. So again, these are not things that help drill baby drill. So let's see if they get to a discussion. I do think, as much as Trump wants to see income from foreign tariffs, I think he really wants to see an absolute stop of any type of drugs flowing across the border more than anything else. And I think that's what ultimately he's going to get to save face, book a huge win for the American people, stopping the drug trade, stopping the illegal immigration, not getting much by way of tariffs. But, and then in addition, he will say, okay, we'll get rid of the tariffs, but you're going to take a ton of our ag, you're going to take a ton of our LNG, and most of them will say yes, as they need it anyway. So it's not in their interest to have tariffs on things that they need, and they will do that. Google's revenue growth slows, their cloud service missed expectations, and their CapEx going from 60 to 75 billion with a negative return on invested capital was not received as positive news anymore. Here is Morgan Stanley's estimates of the Fed funds rate going down. Looks like about 2 cuts this year. We agree with that. Then they're expecting another 100 basis points the year after. We disagree. That would imply a serious recession. We do not think that is in the cards. Video is taking over from text. You can see YouTube continues to grow. TikTok and the Facebooks and the Twitters of the world are declining because they're not as focused on video. Auto unit inventory level. This is what I'm talking about when I say that, yeah, it may increase the cost if he puts the tariffs back on, which are now delayed. May increase the cost of the car a few $1,000, but the demand is still there. And number one, and number two, the theme moving forward is going to be like houses. It's going to be smaller cars, as we've seen with the hybrids and the RAV4s and the Corollas and all that stuff versus the Escalades, which was in 2020. And this has to get back up to a normalized level. This is, well below cash for clunkers level before the last run. So the demand here is just ramping up. Even if it's a few extra $1,000 a car, they'll just build smaller, cheaper cars. And yes, that will hurt OEM margins. It will not hurt as much the auto supplier margins to the same extent. Here's the North American SAR, just like we saw. January is always weak. January is always weak. January is always weak. Every single year, January is always weak. Going all the way back, January is always weak. And then the back half of the year goes. The key is that it's going up year on year. U.S. trade balance with major partners. So you can see here in 2016 was much bigger for China than it is now. Europe has a lot to lose with the trade war more than anyone else. And same with Mexico and same with Canada. You can see the top 5 goods imported by value from Mexico: vehicle parts, trucks, buses, etc., special purpose vehicles. Canada's crude oil. China is cell phones and computers. Analysts are slashing U.S. earnings forecasts. We said this would be happening seasonally. It happens this time of year every single year. Covered the record short interest in bonds, the most crowded trade. Here's the 10-day sum of the advanced decline ratio. Shows the health of the market, the broadening of the market, the greater participation. Here's consumer staples relative to the S&P 500 forward PE. You haven't seen this low of a relative PE ratio for staples then in 2020, and then going back to 2009, and then going back to 2001. I think there's going to be a lot of stuff happening. As a matter of fact, if you looked at the notes that we sent over for Varney on Wednesday, we were going to pitch 2 defensive staples or yield-sensitive stocks that will benefit as bonds get bid and yields go lower. That's staples and that's REITs. So we had Crown Castle International and we had Hormel Foods, the makers of Spam, Skippy, all the type of protein foods you need to eat if you're on GLP-1s, Applewood bacon, Hormel pepperoni, Hormel chili, Spam, okay, all this incredible stuff. So a lot of staples are going to get bid here. No one's positioned for it. That's going to be an opportunity. Equal weight to market cap weight. This is another way of showing Seth Golden's chart here. Tokyo food CPI year on year. Inflation is coming back in earnest in Tokyo. A lot of that's related to input costs because they have no real natural resources. And that's always been their problem, along with demographics and population decline. So as this goes up, the carry trade unwinds, which hurts MAG 7. Tokyo inflation hits the fastest pace in a year, supporting BOG view to continue hiking. Here's the bond yield. All this means is carry trade unwind, MAG 7 pressure over and over. Our base case remains that data centers could drive 3 to 4 billion cubic feet per day of natural gas demand growth by 2030. We love it. We love our Comstock. We still love our Range Resources, and we'll continue to do so. Single stocks trail the S&P 500 by the most since 1999. This was the period, ladies and gentlemen, to flip the switch, where value dramatically outperformed growth for the next 7 years. International over domestic and small over large. Boom bust semiconductor cycle. I wish this chart went back to 2000, but what it's showing here is the cycle is peaking for these high flying semiconductor stocks, now starting to get smashed. World semiconductor sales year on year, followed by Philadelphia Stock Exchange Semiconductor Index. You can see that pointing down, and that tends to follow. Quote, we have got a lot of great quotes of the week, so I want to cover these. This is from Warren Buffett. No matter how great the talent or effort, some things just take time. You can't produce a baby in 1 month by getting 9 women pregnant, okay? And that's the key with turnarounds. Once you do the solvency analysis, you see they have the runway, you know they have a durable moat, then it's just a question of time before you get your doubles and triples, and we play the time arbitrage game. That is one of our major edges. Long ago, Ben Graham taught me that price is what you pay, value is what you get, whether we're talking about socks or stocks. I like buying quality merchandise when it's marked down, not crap from Temu. Okay. Benjamin Graham. In the short run, the market is a voting machine, and I'm going to add based on technicals, based on price, but in the long run, it is a weighing machine based on fundamentals and underlying business growth and intrinsic value. And then finally, another classic from Charlie Munger. A young man comes up to Mozart and says, "With your help, I want to compose symphonies." Mozart looks at him a bit perplexed and says, "You're too young to be composing symphonies." The young man suddenly feels thrown off. "Too young," he quickly replies. "Look, you were doing symphonies when you were 10 years of age. Well, I'm 21. And Mozart grins politely and says, "Yes, but I wasn't running around asking other people how to do it." So there you go, Charlie Munger, classic. On to the news of the week, why Chinese tech keeps surprising the West. DeepSeek is the latest product from China to shock the U.S. tech oligarchy, and it won't be the last. I think we did this to ourselves with the premature ideological sanctions. We took a country that was dependent on us and now made them independent of us. Necessity is the mother of invention, and we've unleashed the genie out of the bottle here. So unintended consequence of bad, ill-thought-out, knee-jerk policy. Not the first time, won't be the last time. Alphabet tumbles as cloud growth slows, missing estimates. We covered that. UBS Wealth reiterated its 6,600 target for the S&P. Tariffs unlikely to be sustained. U.S. manufacturing activity expands for the first time since 2022. This is a theme we've been talking about for months. We would be coming out of the manufacturing depression, and we are. Destock to restock. Here we go, baby. Clients are positioned for this and benefiting. Dollar General is no Walmart. Buy the stock anyway. I kind of like this one. I keep looking at it. Haven't done it because we've got enough low-end retail with Advanced Auto Parts, which is making a nice move, by the way. This is interesting. It's so funny how they change the headlines after the fact. If the stock price goes up, they say, Intel turnaround happening despite not finding a new CEO. Now it says Intel falls on disappointing first quarter revenue forecast. So you can't make this stuff up. These people blow with the wind like a tree. But this is just dead money until they announce a new CEO and we can see what the plan is. But at the end of the day, it's so cheap. We continue to like it. We continue to add. And we're comfortable with that position. Don't count on the Magnificent Seven stocks repeating their winning streak this year. These Wall Street gurus warn. The thing I love about Intel is now, as we're seeing with DeepSeek, you can outperform or perform in line with the advanced chips if you can get the inference right and the model correct. And what I love about Intel is it is the leader of inferior chips. So I think the future belongs to them. I think the superior chips are going to have the harder time as all these startups start clamoring for inferior chips, and Intel is the name of the game. Don't count on the Magnificent Seven stocks repeating their winning streak this year, says these Wall Street gurus warn. We agree with that. We've been saying it for 2 months plus. Trump tariffs risk 29,000 price rise in U.S. home building costs. So that's another factor that has to be considered, and why they probably will be less inclined to reinstitute those tariffs, provided the president follows through on her promise to keep 10,000 troops at the border and drugs and illegal immigration out of our country. And I think that that will be a good quid pro quo. China retaliates against U.S. tariff. Trump-Xi phone call expected. We'll see what happens. Estee Lauder to cut up to 7,000 jobs in corporate overhaul. These are normal things you see in a turnaround. The key is the family owns 38% of the stock. They'll fix it just like the Walmart family. They've not been doing this for 5 years. They've been doing this for decades, and they will continue to do it. This is just a play on the emerging market middle class growth, which is just beginning. Trudeau bends knee. Canada will send 10,000 troops to the border. Name fentanyl czar to delay Trump tariffs. Alibaba offers DeepSeek on cloud service after Microsoft, Amazon, and Huawei. Also, we talked about last week how their Qwen 2.5 is faster on all counts, faster than OpenAI, faster than DeepSeek, so that's why the stock is up. My guess is it takes a rest in February. It's had a huge move from 58 to 100. So if you can get it in the low 90s or mid 90s, probably the last opportunity. I wouldn't hold my breath, but I think you might get a look in the mid 90s for sure. Trump's 2.0 trade war is fundamentally different from 1.0. We covered the reasons why. Let's cover here. What is this? Here are all the ways Trump tariffs could hit stocks. So Goldman was out on Monday. We covered it with Stu, basically saying it would affect, if they stay, which right now they haven't, it would lead to a 3% drop in earnings, a 5% drop in the S&P 500. That was your worst case. So when you see some stocks down a lot more than that, it's great. The beauty of the Trump tariffs in China is that the de minimis exemption that Temu and Shein have been using to ship goods under $800 into the U.S. with no tariffs is now been closed. And that, when people say, well, Alibaba has AliExpress, but it's so small in comparison. Their growth is ex-US in Alibaba. So what's beautiful is the cash machine from Temu and Shein is now going to dry up, which is going to give Alibaba more relative strength in all the other areas, which is great. So I'm glad to see that. On to the next PayPal earnings show. Refresh is working while the stock is dropping anyway. And we covered that in the article this week. We'll get to that in a second. Again, sandbagger in chief Alex Chris is setting expectations low to absolutely crush it once again. Oh, and by the way, he said we're going to buy back $15 billion of stock. And for those of you wondering, what does that mean in English? $15 billion of stock is about, give or take, $77 billion. So 20% of the company, and the stock is down. So you can't make this up. This is beautiful opportunities. Unfortunately, our basis is much, much lower than this, so we're not buying a ton here, but new money came in. We'd probably include that as one of the new positions. Say goodbye to Temu's. We covered that. Alibaba stock is a winner. We covered that. That's coming out of Barron's now. It's not coming from the lady who was the China basher for the last 3 years. It's coming out of new people who have taken over the beat. Strategist who coined the Magnificent Seven warns U.S. tech is set to lag. That is from Michael Hartnett, one of the best strategists on the sell side for sure. Moving along, Sandbagger and the Mouse, stock market and sentiment results. We covered this stuff. The names we were going to cover that didn't have time was Hormel with a 3.7% yield and Crown Castle with a 7% yield. We love that. Here's a picture with the full auditorium and Estee Lauder. Look, this is a kitchen sink quarter with the new CEO, Stephanie de la Faviere. And this one we like and want to build more. It's a relatively small position. We're hoping to make it a bigger position over the next few months. The next one was PayPal. Thing I like here, you can read through all of this, is I like what Jeff did here. He says, sandbag guidance. Ever since Alex Chris has shocked the world CNBC interview, he seems to have figured out that the secret to happiness both on Wall Street and in life is low expectations. Here's what he originally guided for fiscal year 2024. Non-GAAP EPS of $3.83, free cash flow of $5 billion, and share repurchases of at least $5 billion. Here's what the team actually delivered. Non-GAAP EPS of $4.65, so he did 21% better than he promised. Free cash flow of $6.6 billion, which was 32% better than he promised in 2024. And share repurchases of $6 billion, 20% more than he promised. So he underpromised, he over-delivered, taken to the extreme. Once again, Chris appears to be using the same strategy for fiscal year 2025 after seeing just how well it worked in 2024. The company is guiding for non-GAAP EPS of $4.95 to $5.10, free cash flow of $6 to $7 billion, and a share repurchase of $6 billion. But if we see similar upside surprise to last year when PayPal was still in transition phase, whereas 2025 is about partnerships and scaling product adoption, EPS could land north of $6, free cash flow around $8 billion, and buybacks reaching $7.2 billion. History doesn't repeat, but it often rhymes. Love that analysis, and I think that's the key way to think about PayPal moving forward. Disney doing great. You can see here free cash flow, prices lagging, free cash flow recovery. That's going to continue. Price is going to continue to climb, and we'll wind up with our double from much lower levels than here out, 2 years out, and that will meet our IRR hurdles and what we like to see happen in our turnaround Tom specials. So you can go through all the highlighted points from the conference call and all the other work that we do internally if you are serious about your positions. All of this is opinion, not advice. Go to hedgefundtips.com, click on terms. We deal exclusively with qualified clients and institutions and sophisticated investors, etc., etc. So we covered that. And then finally, Stanley Black & Decker, same story. Everyone nervous about the tariffs, completely unfounded, and will prove to be an incredible generational buy opportunity for a durable moat that has been around for decades and decades, the type of businesses we like to buy. Fear down to 39 on the Fear and Greed Index, not what you see near tops. Same thing with National Association of Active Investment Managers, puked out of their stocks last week. So that's that. ARK, the Cathie Wood ETF, top 30 weights, earnings estimates are up 2.2% in the last 60 days. Oil and gas, equipment and services, ETF, earnings power was revised down almost 10% for the top 30 weights in the last 60 days. So we've not been in a rush on the servicers. We think a few of them are getting cheap, but we're just comfortable with our Comstock exposure for energy for the time being, but we'll keep our eye on a few of the servicers. Estimates came down from 275 to 273.63. That's what happens this time of year, and we've covered earnings growth by sector. So with that said, let's get on to the Ask Me Anything questions. Those of you who enjoy that and get value from viewer questions, stick around. Those of you who just like the podcast, thanks for tuning in. We'll be back next week. And here we go for question number 1 is coming from Kyle M. Could you please explain how blackout periods work for corporate share repurchase programs? Usually you have to wait 3 days or so after information is publicly disseminated. He's asking as it relates to PayPal and to Goose. At the end of the day, who cares if they do it in 3 days or 30 days? If they can buy in 20% of the company, in the case of PayPal, or 10% of the company in the case of Goose, you want it at lower prices, not panic knee-jerking. ELF down 75% from highs, still growth trading under 20 forward multiple for 30% growth. Looks pretty attractive here in the 60s. We've covered this a few times. I think I've said no a few times and been right. Let's see if anything has changed. I mean, these are the traps that people forget. So here is a 40 bagger that just because it's down 100%, they got recency bias. They say, 5 minutes ago it was 200, now it's only 100. These broken momentum stocks, they tend to go back to where they started. I'm not saying that's necessarily the case with ELF. Let's see what's happening with the fundamentals, but I wouldn't touch this. This is a broken Momo stock, and I want nothing to do with it. So let's just see if the fundamentals make me wrong. But usually now cash flow is eroding. Yeah, we don't really care about PEs. What we care about is normalized earnings power and a normalized multiple on that normalized earnings power. So there's no way to tell what the actual PE is because the business is just in its nascent stages of deceleration. And this has been a promote. So let's see, John Marmo, what's your opinion on Celsius and Charles River? Celsius we've covered, probably looking interesting. We're not going to do anything with it, but I think that's probably interesting. Charles River, I like stuff in the medical device. This is probably another high quality business I'd be interested in. Let's take CRL. Yeah, definitely interested in Charles River. So we have exposure to medical devices through Baxter. But this is probably one worth looking at as well. I like Baxter because it's more of a turnaround story, but this one is also a pretty solid business. Let's see what the balance sheet looks like. This might be where you have your risk. Yeah, $200 million of cash, $2.2 billion of debt. Let's see if the share count has been okay. It's just they can't get their revenues moving. That's been their problem. Let's just take a look at annual. Yeah, actually, it's okay. Let's take a look at share count. All right, not bad. Yeah, I think this one's definitely worth doing some work on. That's probably a pretty decent find. Not one I'm in a rush, but I think it's definitely worth looking at. Robert Wartanian. Advanced auto parts and Stanley Black & Decker are made in Mexico and China. Tariffs can influence the stock performance in a negative way. It's already done it. If you're at the market discounts, so it's like sell the rumor, buy the news. Everyone's known tariffs are coming. Then once you get the flush on that, then you can actually buy the stock. So I think it's fine, and we covered kind of why. Thoughts on Celanese? We've covered that a million times, Alex. We kind of like it here. Worth doing some work on. FMC, we kind of like it here. That's from that. Felipe Pincos, FMC, same story. We like that. Marlin, Stultz, AMD. What people expected. Do you think this I'd rather stay with Intel. Dale Wilson, Walgreens. I'm not interested in that business. It'll probably be okay, but I'm not interested. It's just, the world has changed. There'll probably be one or two left standing. If it's two, it's going to be CVS and Walmart. Walgreens, if it's one, it's going to be CVS. So that's more of a trade than something I want to own. They'll sell off the Walgreens Boots Alliance. That's fine. They'll pay down debt. I still don't think it's a great business. Asking why I don't mention Intel. I did mention Intel. I just said it's going to be dead money until they announce a new CEO, and that's what it's been. Tim D, Celsius Holdings, same story. Definitely worth doing some work. We're not doing anything with it, but I understand why you like it. Love your podcast. You set up stop losses on positions? No. That's for retail traders. Robert Wartanian, Stellantis? No. Auto companies are healthcare and annuity companies masquerading as vehicle producers. I never want to be on the OEM side. I'll be in the arms dealer side on Cooper Standard. Jimmy Jones. Apple decline of sales in China due to regulation. That, and he's getting outcompeted by Huawei. I mean, you can Google pictures of Jensen Huang with the Huawei folding phones. They're 100 times better than Apple phones. I mean, it's just mind-boggling what's going on. And Apple's looking to partner with China AI and cloud to bypass these issues due to regulation. What are your thoughts on Baba? Baba's going up. There's Apple or not. Okay, that's the bottom line. JP Ding, how much will the 25% tariffs hurt Cooper Standard? Look, there's not another. What do you think is going to happen? Okay, do you think someone's going to say, "Oh, you know what I want to do? Let me go raise $100 million to set up a plant to make rubber sealers for U.S. auto cars in the middle of Mississippi at $50 an hour, plus all kinds of bullshit regulations and OSHA and whoever knows what, so I can get competed away by people who can ship it in cheaper even after paying the tariffs." At the end of the day, the demand is not going to change for the type of products that Cooper Standard sells. The question is, how much is the end consumer going to pay for it? And that's up to Trump. But inflation is just a tax on the poor, and that's exactly what that will create in a short term. So you guys got to think this through a little bit. Gunther Van Arscott. Then thank you, blah, blah, blah. Yeah, same question. Everyone's asking the same question. It's mind-boggling. Rahul Bhatia, congrats on VF Corp. Have you looked at Crocs or Bird? We have looked at Crocs, have zero interest. Allbirds is a garbage company. Complete fad. That's going to be toast. On to the next. That's it. So one of these days I'll tell you how I really feel. But in the meantime, I want to thank you for tuning in. We'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now.